The political conflict over the U.S. debt ceiling is an extremely complicated situation for investors. While nobody wants the U.S. government to default on its debt, it's also difficult to see a path to resolution given the political incentives at play. As I sit here about a week before the date that Treasury Secretary Janet Yellen estimates the government will run out of money, it's simply impossible to predict with certainty the implications of crossing that so-called X date. But a look at a few scenarios may help investors prepare. Ideally, the ongoing negotiations will result in a compromise that allows the Treasury to continue issuing debt. We may have already reached the point where the rating agencies consider downgrading U.S. debt once again. Recall that in 2011, Standard & Poor's downgraded its top AAA rating on Treasuries by a step to AA+, even after resolution of the crisis. In fact, months earlier, Standard & Poor's had reaffirmed the higher rating with the expectation that it wouldn't revisit the issue for several years. If the extent of the damage is limited to a ratings downgrade, we don't expect significant market impact. Many of the investment triggers that led to market concerns in 2011 have been rewritten to focus not on the specific rating of U.S. debt, but rather on its status as an obligation of a sovereign issuer that in principle always has the means to repay its debt. If despite all efforts we cross the X date, we enter uncharted territory. The government may prioritize certain Treasury payments, the U.S. may enter technical default where the government breaks some, but not all debt obligations, or the president may attempt constitutionally untested executive actions. But any of those decisions likely would face challenges in court, with the outcome uncertain for some time. Even without technical default, a downgrade to U.S. debt is very likely without a debt deal. Whatever bonds are issued probably will be tainted until the courts rule on their legitimacy. U.S. government bonds underpin the global financial system, so it's difficult to fully gauge the damage a default would create. It's likely that we would see a massive increase in volatility across equity, debt, and other related markets. Treasury liquidity may be severely impaired, and market dysfunction would likely quickly spread to the derivative, mortgage, and commodities markets. The truth is that we would be in uncharted territory. When the dust settles, the effect on Treasury yields may end up being counterintuitive if the government defaults. Treasuries will likely still remain the relative safe haven asset. In that case, investors may want to keep in mind that intermediate and longer-dated Treasuries could actually rally, even as other flight-to-quality currencies benefit, at the expense of the dollar, at least temporarily. Generally, we've avoided Treasury securities that mature within the X-date window, largely from June to August, and have further prepared by taking less active risk in our portfolios. That can help leave powder dry, so to speak, should we find opportunities if the market appears to overreact.